On March 7th, 2024, a federal grand jury in Austin filed charges, now made public, against 7 individuals accused of conspiring to defraud the IRS using stolen identities. The indictment names Abraham Yusuff from Round Rock, Meghan Inyang from San Antonio, Christopher Eduardo from Round Rock, Christian Mathurin from Nashville, Tennessee, Dillon Anozie from San Antonio, Babajide Ogunbanjo from Austin, and Aydin Mammadov from Houston. They are alleged to have worked together between 2018 and 2021, submitting at least 371 fraudulent tax returns to claim over $111 million in refunds from the IRS. Yusuff reportedly led the scheme, recruiting others to provide addresses for the operation. He and his accomplices allegedly impersonated authorized tax agents by using stolen taxpayer and accountant details. They then requested that the IRS change the taxpayers' addresses, allowing them to intercept sensitive tax information. Using this information, they filed fraudulent tax returns and directed the refunds to multiple prepaid debit cards. Some refunds required IRS verification, so the defendants allegedly impersonated the taxpayers to authorize the release of funds. Once funds were loaded onto prepaid debit cards, Yusuff and others reportedly laundered the money by buying low-value money orders to evade reporting requirements. They also used the funds for personal purchases, including designer goods, home renovation materials, and used cars. Each defendant allegedly retained a portion of the money orders as their share of the fraud proceeds. The indictment lists various charges, including mail and wire fraud, identity theft, money laundering, and fraud involving access devices. If convicted, the maximum sentences could range up to 20 years for certain charges, along with financial penalties, restitution, and supervised release, with the exact sentences to be determined by a federal judge. Explanation of the fraud scheme. The group allegedly ran an organized scheme involving identity theft and fraudulent tax return filings. Here's a breakdown of how they operated. Identity theft and impersonation. Using stolen identities of legitimate taxpayers and accountants, the group registered themselves as tax agents authorized to manage tax information on behalf of these individuals. This allowed them to receive sensitive tax details intended only for the true taxpayer. Manipulating IRS address records. They changed the taxpayers' addresses on record with the IRS so that the agency would send tax-related documents to addresses controlled by the group. Filing false tax returns. Using the stolen tax information, they submitted 371 false tax returns, claiming substantial refunds. The refunds were directed to prepaid debit cards, helping them avoid detection. IRS verification evasion. In cases where the IRS sent verification letters before releasing refunds, the conspirators allegedly impersonated the taxpayers to push through the fraudulently claimed refunds. Money laundering through debit cards and money orders. Once the refunds were loaded onto debit cards, the group laundered the funds by buying money orders in small amounts, avoiding transaction reporting thresholds. They used these funds for personal purchases, such as designer items and home improvement materials, further concealing the fraudulent gains. This case highlights how the group used identity theft, falsified tax information, and IRS procedural gaps to fraudulently obtain millions in tax refunds.